this guy probably doesn't even know I exist, and he wasn't really asking anybody else about ACB, but he did post that he had a position in ACB, and I jumped in on that. So, but anyways, let's get to this question real quick. That's not really a question. Okay, so this guy posted that he bought ACB contracts. And let me move out of the way a second here and see if this is going to work. This guy bought 10 contracts for ACB. They are let's see. It looks like there are 6 calls in August, expiring August 16th. And I replied, why would you want to buy the ones for next week when everything is, relatively speaking, in ACB, you can go out farther for just a couple cents more. So let's analyze and talk about ACB for a second. We'll look at this trade, and we'll look at our options as far as options go. All right. So let me lose the cowboy hat here. So ACB, Aurora Cannabis, and we of course have to be careful on YouTube saying stuff that has to do with cannabis because they immediately demonetize you if you mention such things, and especially if you mention them in the first minutes of your video. So I probably shouldn't have even said that. ACB is an issue we've been following for a long time, and essentially this is a candidate to be taken over at some point. The MJ stocks really have struggled over the last year as reality set in. It started out and it was such a kind of sexy thing to own MJ stocks, and the prices exploded and went to the moon. So we'll do a quick refresher here. If we back this out to 3 years, you can see ACB coming from printed zero down there in 2017, but essentially coming from like hanging out around $1.50 between 2017 and then right at the end of 2017 was this huge spike, and this happened in all of these issues. At that point, they were calling ACB, CGC, and Afria the big 3 of Canadian MJ stocks. So we've got ACB, CGC, and you're going to see a similar pop up in CGC, that being Canopy Growth, and Afria. And at that time, to trade these, you had to go to the Toronto Exchange. They were listed OTC in the U.S., but since that time, some of these have been listed in the U.S. Afria has been listed in the U.S. Actually, all 3 of them have been. And they all have this similar huge move up in December of 2018. And then since then, look, it's just a big sort of consolidation. And this was like the hype, and everybody, wow, I'm going to get, it sounds cool. I'm going to buy these MJ stocks and make money off MJ legally. And everybody was so excited about it. But then the reality of an industry, which is basically a commodity industry, set in. And then there was more hype because people were saying, wow, this is going to, we're going to go to the local gas station and there's going to be Marlboros, and right next to Marlboro cigarettes is going to be Marlboro pot. And it seems that the business of cigarettes, where you had these e-cigarettes, was a huge deal also back then. And the big one now that's really come through as the market leader has been Juul. Juul was acquired last year for, I think it was $15 billion by Altria. Okay, so Altria Group. Well, actually, they paid $12.8 billion to own 35% of Juul. And Juul had been valued at, I think, $7 billion before then, and they paid almost double for Juul. And Juul is super popular. I can tell that because that job I work 2 days a week at Cumberland Farms, people come in and buy these Juul pods all the time, every day. And so the belief was, wow, this is the conclusion of this is going to be that people come in and they buy e-cigarettes that have marijuana instead of cigarettes. And there was all this hype going on, but the realities of the marketplace and actually producing products for these companies and actually the mechanics of a company have brought them back down to earth. We saw the hype and craziness over Tilray last year with the big spike, and that kind of propelled the market forward a little bit for these issues. Here's the Tilray spike. You can see it got up to 300 and then kind of faded since then. It's a very new industry, very volatile. And the thought was that, you kind of get confused because you see all these prices all day, right? And you're like, you see a stock like Amazon or Netflix and you see it doubling, tripling, and you think, oh, well, I'm trading this company, ACB, it's only $6. Then it seems very conceivable in your mind that this could go to like $6,000. But the reality is that it's already valued as a pretty expensive company at $6. And to justify it going higher, they have to perform A, or B, they have to be acquired by somebody. And so a lot of people got hurt on the down move in these things, and they want to try and make that up, bring their P&L and these things back to positive. They want to prove they can make it in these MJ issues, and thus there's a lot of bag holders out there everywhere. But the question is where is the time to buy? These companies are going to make money. They are going to move forward, and at least some of them are going to be successful. And the question is, which ones are going to be successful, and where do you actually jump in and play a little bit? And I've had several false starts in these. I think I'm up money in ACB Lifetime. I'm definitely up money in Afria Lifetime. But the question is, if you buy a little, you kind of have to get out as soon as you make a profit, because you never know when these are going to go back down. Now, is there a base around $5 in Aurora? It kind of looks like it. So this is kind of the framework that we're looking at when we're looking at options trades here. And when you have a stock that's around $6, when you're looking at the options, looking at volatility numbers is not as meaningful as looking at actual dollars you're paying. So when you're looking at a cheap price stock like this, if you want to replace your long with options, it costs you to buy 100 shares, costs you $650 essentially in ACB. To buy one of the 6 calls costs you $73, and that's going to control the equivalent of 100 shares of stock above $6. Now, if it goes below 6, your $73 can become worthless. Whereas if you bought the stock for $650, if it goes below, you still got most of your $600. So that's the difference there. But there's several strategies we can take if we, when people buy calls in a stock like this, at least I don't know what everybody else is thinking, but what I'm thinking is, wow, a takeover rumor could come out and this thing could pop. We did see a pop in Afria last week when they announced, I think also maybe ACB, when they announced guidance that they thought this was going to move higher. We did see a pop in Afria, but look, it just faded completely away, the pop in Afria. So if we go just to the weekly in Afria, here's a 10-day chart. Boom, pops from $5 up to a high of $760 a couple days later. Now it's back to $630, and it wouldn't be surprising if this fades back to $550. So when we're buying these, we don't just want to get chipped away. So what strategies can we employ to use our money wisely if we have the opinion that this is going to have a pop to the upside? Now, we're not necessarily saying this is going to $30, but we say, well, we could hope that this goes back to the all-time high of like $12.50. And, for that to happen and this to double would be a great win for somebody who's long. So how do we work on that? Okay, well, the viewer comment was that they had bought some calls expiring on the 16th, which is will be the front week starting tomorrow. We're on Sunday right now. And if we compare these options here, we can see that if we look at the front week calls this week, 50-cent bid at 60. If we move out a week, we get 60-cent bid at 62. If we move out another week, we get 65 cents at 67. So, you're paying $1 or $2 extra for another week of play. So my comment was, well, why not just go out to like December? So the December calls, the 6 calls, instead of paying 50 cents, or instead of saying 60 cents, you're paying $1. However, these are decaying. It gives you a lot more time, 131 days, and your decay is much less. So if we model the decay of buying 100 of the 6 calls in the front week, so I'm going to go in here, I'm going to type in buying 100 calls. Then I'm going to right-click and do Analyze Trade. And it looks like I already had it trade from before. I'm going to pull this up and make sure that that's the only trade in here. So let's get rid of this other trade. So if I buy 100 of these calls, that's going to get me, it's going to show me long about 8,000 deltas, right? So each buck this goes up, we make $8,000. This is going to cost me so anyway, so if we buy 100 calls, this is decaying by how much per week? Well, it shows here the decay is $92 a day. Okay, so, but if we move this, what we can do to model this stuff, it's really nice with this, is we can just change the month and model it. So if we move these up to December options, they're only decaying by $26 a day. So you've got like a quarter of the cost of carry for the December one. So even though the December ones appear to cost almost twice as much, the decay is a third or a quarter of what it was for the front week one. So if you were to hold these all the way to December, it's going to cost you more. But holding them for a week is going to cost you way less than the front week ones. And it costs more. It's going to cost you, instead of $6,000, you're going to have to pay $10,000. However, it is going to save you in the long term, because if you just want to hold these for a week and see what happens, you could buy the December ones and then just sell them out after a week, and you're going to be in better shape than buying those front week ones. So what other strategies can we use besides buying calls like this? There is a strategy we could use, and this company, I don't believe the stock is hard to borrow right now. I believe it's just like it's easy to borrow. Let's see if we can find it. Yeah, I believe it's not hard to borrow. But just in case, either way, if we could employ a strategy of buying puts in stock, thus buying synthetic calls that will allow us to profit even if this goes down. So to do that, instead of buying the calls, we could buy, and you might employ this strategy when we get a little bit of a pop. But you can buy, instead of buying those calls, you can buy the puts and stock, right? So if we were to look out to December, you could buy this put for 80 cents and buy 100. And then you could go ahead and hedge these delta neutral with stock. So you buy 100 puts. It's going to show you getting short 3,300 deltas. So you buy 100 puts, and maybe you buy maybe you turn half of them into calls, right? By buying 5,000 shares against them. So let's just kind of queue up that trade here. So if we go trade, analyze tab, and we go to buy the stock. Why am I having a hard time with this? Analyze, add simulated trades. If we click on the ask for the stock and under analyze, then it's going to show us buying stock. So if we were to buy 5,000 shares of stock against these puts, then, okay, so this way, we are leaning a little bit long, but we will also benefit to the downside if things just go really against us. And the added benefit of buying puts and stock is that we can start to look at our sheets after this. And if we go up a little bit, we can sell some stock against this position. If it goes back down, we can buy some stock. And so it's not with buying the calls. It's almost like you've got this bet on, and you're just waiting for something to happen. If you buy puts and stock, and you could also sell some stock against the calls, but in this case, with the puts and stock, you don't have to worry about this becoming hard to borrow. Or if you have a hard to borrow stock, there's no issue because you're starting out owning a stock and you're letting some go as it goes up, and you're buying a little more as it goes down. But in this case, if we go to our risk profile and look at the chart here, okay, we're leaning a little bit long. We're going to make money to the upside if it goes up. And this is just showing how much this is going to cost us by December if nothing happens at all. We're going to lose that $10,000 we paid for these puts. But our break-even price here currently is for this to go to 660, so up 10 cents. And with buying puts in stock, if this goes up a little bit, we can sell some of our stock to keep us delta neutral. If it goes down a little bit, we could buy more stock. And in the meantime, we can trade around our position here. So I like this idea of puts in stock. I was using it with another stock, Candy, recently. If we pull up Candy, this is a $5 stock, but it tends to have these little gappy moves. And so if you were to buy in Candy, for example, the 5 puts, maybe you buy the December 5 puts for $1. And you might have a bias either short or long. That's up to you. But if your bias is just sort of neutral, you can buy these puts in stock. Say you buy 100 puts. Pull that into our Analyze tab here. Now there's a theme here. The theme is you can check out trades and try them out in your Analyze tab. So it's showing here just buying the puts would get you short 4,000 deltas. So we can go click on the ask. And if we were to buy 4,000 shares against this trade, now what we have is what we as market makers would call a back spread. You own options, you hedge them with stock. Now, if Candy goes up, you sell a little stock against it. If it goes down, you buy a little stock against it. And meanwhile, if you get a gap, you're going to make money. In the meantime, your goal with this trade is to cover this decay every day. You're trying to cover that $31 a day in decay by buying and selling the stock as it moves back and forth. And I made a video on how to do that. The way you would hedge this is you would put ahead of time, you would put scaled bids and offers. So we can see down 10%, you have 900 shares to buy here. Let me get out of the way. You can see down 10%, you've got 900 shares to buy here. Up 10%, you've got 700 shares to sell. And so you might want to put scaled bids and you put this position on, and then you're going to put offers up above where the stock is trading and bids down below where the stock is trading. And as the stock moves around, you're going to get filled on your bid. As soon as you get filled on one of your bids, you can put an offer like 50 cents higher, and you hang out. And if you get a gap either way, you make money. In the meantime, you try to finance your position until you get that gap up. Having a back spread on and trading it can be a better deal than just buying calls and hanging out. So in ACB, we go back to that. If we were to buy the 6 puts in stock like we were talking about, and let's hedge this delta neutral this time for this example. So without this stock in here, it's showing us short 3,300 deltas. So let's buy 3,300 shares of stock when we put this trade on. And that's going to get us flat. Now it's showing, okay, up 10%, we've got 700 shares to sell. Down 10%, we've got 1,000 shares to buy. And as the days go by, we just adjust for what our delta shows. And this is costing us $35 a day. So your goal is maybe not every day you can make that $35, but over the course of the week, you're trying to cover that decay. And this can be a better way than just buying calls and hoping something happens. I would suggest with this, though, if you are bullish on it, that you do, stay. Okay, you can say, like, I'm going to lean a little bit long, so I'm going to add 2,000 shares to my hedge here. So it's going to be 5,300. And so for me, with that bias, delta neutral is going to be long 2,000 deltas. So I want to stay always long 2,000 deltas. So now, so maybe you're going to buy 5,400 to start with. So now, up 10%, you're going to sell 800 shares to keep it long 2,000 deltas. Down to 586, you're going to buy 1,000 shares to keep it long 2,000 deltas. So you're always leaning a little bit long. If it gets taken over or something, or there's rumors, it's going to go up, and you're going to have stock to sell up there. But the beautiful thing about this is you get a pop in the morning, you've got something to do. This thing, you come in the morning, this thing pops to like $7. Let's go to 20-day. Come in the morning, you get this pop to 720. Well, you go ahead and you sell the shares that you need to sell up there at 720. Then when it comes back down in the afternoon, you're buying it back. So you're making money both ways with this position as opposed to just owning these calls. So this is a back spread. And when you put this on, you are the things you're looking at are, do I think I can cover this $35 a day? And that's largely going to also have to do with your bias as if you think this is going up or not. You could turn almost all of these puts into calls by buying, like, there's 100 puts. So to turn them all into calls, you buy 10,000. You might turn 75% of them into calls by buying 7,500. And your sheets would show you long 4,000 deltas. And maybe when it does get that pop up there to 720, you say, all right, well, I'm long 4,000. Up here, maybe I'm long 5,000 or 6,000. And you say, I'm going to give it all to them up at 720 because I think that this is a sort of unrealistic pop and it's going to fade back down like it has so many other times. So it gets up to here. Okay, now I'm going to turn all these puts back into puts. So I'm going to sell out all 7,500 and turn these back into puts again. And then as it fades lower, buy your shares back in. So it gives you something to do. It gives you stuff to think about if you are to put a back spread on in one of these issues. And that's kind of what that's called. The other question I know that people were asking with ACB if we're just going to replace, we started with the gentleman owning the front week calls. So the question was, which calls would you rather own than the front week if we're going to pick some? And one viewer had a smart idea. He said, okay, well, let's look out and see when earnings is, and let's buy the calls so that we get 2 earnings cycles in those calls. That way, We've got 2 earning cycles to play in this thing. So that seemed like a decent idea to me. Let me pull up the StockTwits thread on this and we'll look at it again. All right, so here we go. And this was Canterbury89. He says, thanks so much for your input. Yeah, I was going to buy more at the date further out. I just sold 8 contracts yesterday, took the profit, and bought these 10 for next Friday and was going to take a longer position. But actually, I don't have a target date in mind. Any thoughts on December, or was that just an arbitrary date you were using as an example? And the answer is yes, that was just an arbitrary date I was using. But if we continue on this thread, somebody else came in and said, I went with Jan. That way you get the next 2 earnings. This is the last one sitting. I like that idea. And these things we're thinking about, they're going to apply to all lower price stocks. So it's good stuff to talk about. The other thing we can do, of course, is if you do buy some of those D's calls, let's say that we did buy some of these D's calls. We bought 100 D6 calls. And let me turn to calls. And now you're along 6,700 deltas. Okay. The other thing you can do to, besides scalping back and forth on these, selling some stock and buying it back, that sort of thing, to cover this theta, is you get a pop, you sell something against it. You sell another option against it. So we bought these December calls. Maybe this thing pops 2 weeks from now, and you can sell the same call, the same strike in a different month against it. That selling the same strike in a different month is going to be advantageous for your buying power as well, because it's going to be treated as a calendar spread. So maybe you buy these for these December calls for $1.05, and you get a pop next week, and actually these August calls actually trade up to $1.05. Well, why not sell the same amount of August calls against them, and all of a sudden you've put on this calendar spread for free. You lagged into it for free. Now, the issue with that is going to be that these calls, if they got up to 105, they're going to be in the money, right? And so you're not going to be able to keep this position on for very long, because these calls, you're short, you're going to get assigned on, and they're going to be traded in for stock. You're going to have to give somebody stock. So you don't probably want to put that trade on for very long. You probably don't want to sell these like 2 weeks out calls against it, because they're going to get the calls are going to get switched for stock because you're short them. So you might want to pick something a little farther out, maybe the September ones you sell for, $1.10, $1.15, and then you worry about rolling them later once it gets closer to their expiration. In the meantime, if you were to sell, for example, these August 6 calls, if we were to sell some of these, it's going to decrease your, if we were to sell 50 of these, for example, it's going to decrease your theta decay a lot. So look, sell 50 of these calls. All of a sudden, your theta is positive. If you sold half the calls against it, you're actually collecting money every day. So if you don't have time to scalp back and forth to cover your decay, you could always sell something against it. Just remember that when you're selling these sooner month calls against it, you are limiting your profitability if it actually does get taken over. I mean, the last thing you want to do is have these December calls, which are golden if this gets taken over, but you've sold so much against them that the thing gets taken over before the stuff you sold has expired, and you end up not making that much money because you hedged everything completely. A hedge is a good protection, but hedging also limits your profitability a lot. All right, so that's some ideas for a lower price stock. I want to talk for a second against one of my other ones that I kind of want your opinion as viewers on, and this is MNK. Mallinckrodt. Now, this stock is a company that makes was caught up in the whole opioid epidemic stuff and has faced a lot of litigation. It also has some other products in the pipeline. I'm not a complete expert on everything that's going on with this company, and it can be difficult trying to pick the bottom in these stocks because some of them eventually do just go out of business. But this company seems to be making money and seems to have decent prospects, and the stock continues to go down. So I think that this could be an exception where there is a turnaround here. And the question is, where do you get in? Now, it looked like we had a turnaround going just a couple days ago. This got down to 512, and then it rallied all the way to 625, which was a decent pop up. But now back down all the way to 5. So this is another one where we could look at options. And the pricing on this, option prices are significantly higher than ACB. So you have to be a little bit more careful. But I still like the idea of maybe buying like some Jan, maybe 5 calls. And just as a replacing buying the stock with buying some Jan 5 calls and looking for a pop to do something against this, whether it be selling some other month. And you might take the strike up even higher. Maybe you look at the Jan 7.5 calls, and then you turn this into, or let's stick with the Jan 5s, and you turn this into our poor man's covered call. So you buy these Jan 5s and you pretend they're stock, right? You buy 100 of these calls, and this is as if you just bought 10,000 shares of stock. Then on a pop, you sell some other out of the money call against it that you really don't think the stock's going to get to, but you think it's going to get close maybe. So maybe you go out to September and you sell some of these September 6 calls for look at how wide these markets are, 40 cents at 130. That's the problem with one of these, is that you need to be a little bit more finessing with it. So anyways, let's say you can sell these 6 calls for 65 cents. Sell some of these 6 calls for 65 cents. Let's say you sell 50 of them. And hold on, I've got a bunch of crazy trades in here from before that I was analyzing. All right, so we're selling those SEP 6 calls. We bought the Jan 5 calls. Let's say we bought 10 of the Jan 5s and we sold 5. I don't mean to always use 100. I know a lot of people are smaller than that out there, but so let's use 10 and 5 now. Okay, so we bought 10 of the Jan calls. We sold 5 of the SEP calls, and now we've got a nice little position on. Look, you're collecting $5 a day. You're long 400 deltas, and you've got a nice little risk profile here. You're long, and you're getting paid to be long. If it stays right where it is, you make money. If it goes up, you make money. The only way you lose money is if this rolls significantly lower. So we like this trade. It's fun to put trades on with options where like you get paid if it stays in the same place, you get paid if it goes up, and you only don't get paid if it goes lower. That's a nice kind of trade because you're not sitting there going, oh, I'm getting the decay's killing me on this thing. I need something to happen right away. And that's sort of the difference with buying, just straight out buying front week calls in ACB. You're like, oh, something better happen quick. It's so much more of a shot than crafting a position like this where you're getting paid every day. How can we craft a position in ACB like this? Well, let's pull up ACB again and do it. So let's clear out everything we had in ACB. So how would we craft a position like this where we're getting paid if it stays in the same place? Well, let's just do the same thing that we did in the last talk. We'll look at Jan. Let's pick Jan 5 calls. Let's do that. Jan 5 calls. We'll buy 10 Jan 5 calls. Then we'll go back out to August, maybe. And we can look at August. See, I want to pick something that's a little out of the money. So let's move out to September. So we'll pick September 7 calls. Now, this is lower volatility than Mallinckrodt, so it's a little bit harder to do, but we can still do it. So we'll sell September 7s. We'll sell 5 of these. and you know, it's not a ton of theta. If we were to multiply this out to 100 times versus 50. Okay, so now we're long 6,000 deltas, but we're collecting $16 a day. So it stays where it is. We make money. Goes up, we make money. If it goes down significantly, it's not going to be good for us. But if you're looking at a spot with ACB where if you kind of get the feeling, or not the feeling, but from your charts, it looks to you like, you know, 5 is the basement for this thing. You know, it's really not going to get below 5. And, you know, there's some evidence for that with this issue. It's bounced off there before. We've seen several bounces off, even actually kind of like the 6 area. There's a case to be made for putting a position on like this. Once again, we are buying deeper calls in January. We're selling slightly out of the money calls in SEP. We call this like a poor man's covered call situation. The Jan is like stock, and the SEP, you're overwriting it. And so with this position, you know, you have a weekend, big deal. You're collecting money. It goes down slightly, big deal. You'll recover it going down slightly by collecting money. If this starts to rally even a little bit, all of a sudden you're collecting more money and you're making money on your delta. So craft a position where the decay every day is positive. And the way you do that is selling some front month stuff against back month stuff you buy. This is a little bit more complicated, but a more it's a more cerebral position. You know, you've thought about it a little bit, you've crafted it together with a little bit of your options knowledge, and you're sitting pretty over the weekend when nothing's going on and people are like, you know, paying for their decay. You're collecting money. You get that pop up there to 720. All of a sudden, you've made, you know, $3,000, and then you can decide what you want to do with your position then. You know, this pops to 720, and you've got options. You can cover those calls you were short and roll them back up to a higher strike. You can sell some stock against those Jan 5 calls you're long. But either way, you're not like, you don't have this deadline of next Friday, like, things better happen by this next Friday or I'm going to lose $90 a day. Much better to be collecting 16 a day and have a similar outcome that you're predicting. So there's that. Hope that helps out a little bit. I'm going to go back here to my dashboard for a second and see what happened with that. Let's see. Have I lost you? Are you guys still there? Cheap stock's cheap for a reason. Indeed. Address the elephant in the room. Oh, are we talking about Vanny Love still? I can give you my favorites list privately sometime. Vanny Love is not my top favorite. So there you go. That's so funny that you guys saw that. I don't spend money on these things. I just find them interesting. But it's so funny that you found that. I didn't even see that. I'll have to look back and see where it popped up on there. But yeah, I think that's like it's one of the most popular websites in the world. Let's look at the rankings here. I think it's called Alexa website rankings. Alexa, yeah. Yeah, if we look at Alexa, I think Chatterbait is like, it's one of the top ones in the world now. I think it's like 29th. Menu. Alexa, top website traffic. Top sites, Alexa. Here we go. Well, there's live Jasmine at 30. Well, maybe it was just giving like the top by country ones. Let's try the top by country. Maybe that's why where it was the top. Craigslist, Twitch. Well, maybe it was just the top 30 in my mind because I don't even see it in the top 30 here now. Oh, boy. That is funny. Anyways, yes, I might have heard of Vanny Love before. I'm not quite sure. It might have happened at some point. I might have heard that name somewhere. I'm not quite sure where from, but it sounds somewhat familiar to me somehow. Anyway, so there you have it. Let's take a quick look at volatility before the show ends here. Let's pull up the VIX. And we see things kind of came back on Friday with the market. There's speculation that we're going to move way lower. There's definitely fear out there, but things kind of came back. UVXY trade ended up 32.47. Now our position along the 30.27 put spread, we don't really like $32 that much, and the clock really is ticking on this one. So either we move lower or we're going to have to make some sort of move here. Because, as I said, the clock's ticking on this position. We've got 26 days left till expiration, and it is going to start hurting us if we don't get a move down here. It's showing $34 a day in decay right now. I feel comfortable with the position. I feel like we are going to move lower, but I want to keep an eye on that one because we definitely have risk here. If we look at VIX Central, we kind of move between backwardation and contango a couple times. We can see they did end the front month 2 futures slightly in contango, but the chart, the term structure, very flat right now. Kind of spot kind of just moving through. It's definitely seems to be still kind of in a spike situation. It seems like it wants to go below 17. You heard me a couple days ago saying it would need to go below about 1750 for a spot to be below everything. I think that's still true. It wants to line up below there. There's no reason why this can't go to 11, but there's no reason why it can't stay up around 20 for a while either. So it's really kind of up in the air. It doesn't really know what it wants to do right now. Market's kind of in flux. It was interesting to me that we kind of saw that first down spike. If we go to the 5-day here, okay, so we had this recent bottom here at 27.75, and then we built for a day. Now this Wednesday, this down move here, Wednesday, volatility really cranked again on this move. It almost got to as high as it was on the big down move there. And let me move to a 20-day. We can maybe see this better. Okay, so we get this huge down move here. Volatility goes to 24, and then comes back a little bit. Then we get this move down here. It gets almost back to 24 again, just on this relatively speaking a smaller down move here. And so people were nervous right here. Definitely, people could feel it like, oh, we might take out the lows here and move way lower. People got very scared on this one down move here, and you could see it by the crank in volatility right there. It was like a big scariness. You would think with the chart having come back that you wouldn't, that the spike would be receding a lot, but this down move really put fear in a lot of people, and I suspect people got hurt here. People who had kind of bought the market sold it back out again here, but we did see this continue to move upward here and hold on to the gains. But definitely some fear out there. I suspect that the weekend is going to be to kind of reset people and calm people down. And I suspect we will move higher from here, but time will really tell. We don't know. Like I said, our position right now is pretty risky because it's pretty close to expiration. We're like 26 days to expiration. So the thing is, either we get what we want, which is get this to, UVXY to move to like 28 in the next couple sessions, or we're going to have to make a decision here, either close out the position or roll it out. I would like to close out this position for decent profitability and then switch back to selling some naked calls. That would be an idea for me moving forward here. But we need to get a win here to do that, in my opinion right now. So that's the deal. I am considering maybe buying some MNK, some sort of maybe the poor man's covered call or something, because I think it's a decent bet that this company is not going to go bankrupt. And if it's not going to go bankrupt and it's making money, then it will move higher at some point. The question is, when does that turnaround happen? So many of these where you try to catch the bottom here, you kind of just get ground into the dust. If this just grinds from 5 down to 4 over the next year, that's just going to hurt a lot of people, including us, if we put a position on. So very tentative with this MNK, but probably will dip my toes in the water soon on that one. Thanks for everybody's enthusiasm in the chat. You guys are hilarious. Keep your questions coming. I hope you guys make some money. Cheap stocks definitely are cheap for a reason. That's why we don't generally play with penny stocks. I